The JEPI ETF, JPMorgan Equity Premium Income ETF, is an attractive option for dividend seekers. JEPI offers a diversified portfolio of stocks that pay attractive dividend yields, making it an interesting investment choice for those looking to generate income. In this video, we will explore the pros and cons of investing in JEPI and assess whether it is a good investment for dividend seekers or not. So, before we get started, please subscribe and don't forget to turn on notifications to keep the videos coming. What is the JEPI ETF? The JEPI ETF, JPMorgan Equity Premium Income ETF, is a popular exchange-traded fund that seeks to provide investors with exposure to large-cap U.S. stocks while generating attractive levels of income through dividends. The fund tracks the JPMorgan Equity Premium Income Index, which consists of 50 stocks selected by JPMorgan's quantitative equity research team. The JEPI ETF also utilizes a value tilt to focus on companies with strong dividend yields and sound balance sheets. JPMorgan Equity Premium Income ETF was formed on May 20, 2020, and is domiciled in the United States. The fund invests directly and through derivatives in stocks of companies operating across diversified sectors. It uses derivatives such as options to create its portfolio. It invests in growth and value stocks of companies across diversified market capitalization. It invests in stocks of companies that are deemed socially conscious in their business dealings and directly promotes environmental responsibility. JEPI also seeks to deliver a significant portion of the returns associated with the S&P 500 index with less volatility. JEPI does this by investing up to 20% of its assets into ELNs, equity-linked notes, and selling call options with exposure to the S&P 500. This strategy did its job well last year, as JEPI fell just 3.5% versus a much larger 19.6% decline for the S&P 500. However, it should be noted that this strategy may also limit some of JEPI's upside when stocks are surging. Why is it attractive to dividend seekers? JEPI is an actively managed fund that seeks to generate income by investing in U.S. stocks that have low volatility and which appear undervalued, and through investments in equity-linked notes which provide the economic exposure of the U.S. stock market. The ETF's popularity can be attributed to its double-digit dividend yield, its monthly dividend, and the fact that it comes from a blue-chip sponsor, JPMorgan. Its portfolio consists of domestic large-cap stocks and non-U.S. equities. Not only that, but JEPI's dividend yield is a massive 11.8% on a trailing basis, which is more than 7 times the average yield for the S&P 500 of 1.65%, and nearly 3 times the yield that investors can get from 10-year treasuries. There are few things investors enjoy more than receiving a dividend payment each quarter. However, a popular ETF from JPMorgan, the JPMorgan Equity Premium Income ETF, takes this approach and does it one better by paying investors a dividend every month. The JEPI ETF also offers diversification benefits for dividend seekers by investing in both U.S. and international stocks. This helps reduce single stock risk and reduces volatility in the overall portfolio. The ETF is also cost-effective with a low management fee of 0.35%. JEPI may be tax inefficient, as distributions from the fund may be taxed as income, and dividends from underlying stock holdings are not considered qualified because of the offsetting options positions. Moreover, the fund has a track record of consistent performance since its inception in 2014, with total returns averaging 10.3% since then. This makes it an attractive option for investors looking to receive steady dividend income while potentially taking advantage of stock market upside over the long term. JEPI Holdings. The JEPI ETF, JPMorgan Equity Premium Income ETF, is a diversified portfolio with holdings spread out across 115 U.S.-based stocks. The fund seeks to track the performance of the JPMorgan Equity Premium Income Index, JEPI, which consists of stocks from both developed and emerging markets that have high dividend yields. Its top 10 holdings make up a mere 17.1% of assets, and no individual stock makes up more than 1.97% of the fund. The consumer staples segment is well represented in the top 10 through soft drink giants Coca-Cola and Pepsi, as well as candy company Hershey. Pepsi and Coca-Cola are dividend kings that have been paying and increasing their dividend payouts for 50 and 60 years, respectively. So these are the types of stocks that you want to own in a dividend ETF. Financials are also well represented in the list. Progressive, an insurer, is the largest holding, and it is joined by another insurance company, Travelers, in the top 10. Meanwhile, payment networks like Visa and MasterCard make an appearance as well. Also, the healthcare industry has a heavy presence in the top holdings through stocks like AbbVie and Bristol Myers. The healthcare industry is generally thought of as a defensive business, and healthcare spending is less linked to the overall economy. So, this is an advantageous sector for a dividend fund to target. Be informed that JEPI also owns some non-dividend stocks, such as Amazon and Alphabet. It likely owns these types of names to generate income using their derivatives and to gain more exposure to the upside potential of growth stocks and the S&P 500 as a whole. Overall, the JEPI ETF provides investors with access to a diverse portfolio of equities from both developed and emerging markets with a focus on dividend yield. Investors should consider this fund if they are looking for a way to generate current income from their investments. What are the risks? Investing in any exchange-traded fund comes with inherent risks. The main risk of an ETF like this is that it could lag the broader market during a bull market, as evidenced by this year's underperformance versus the S&P 500 and the Nasdaq. In any case, adding some ballast to your portfolio never hurts. The market has been volatile recently, and if the market takes a turn for the worse as 2023 unfolds, JEPI should hold up well, as it did last year. The other risk here is that as a fairly new ETF, JEPI doesn't have a long track record of returns, but the portfolio managers in charge of the fund, Hamilton Rayner and Raphael Zingung, have 36 and 32 years of experience respectively, and JPMorgan is a blue-chip asset manager, so you can be less worried about that. Many investors own JEPI and view it as a key cornerstone of their portfolio that gives them some downside protection, exposure to a large swath of the U.S. economy, and, best of all, a steady stream of monthly payments that add up to a well above average 11.8% yield over the year. And that's all for today's video. We hope you found this video informative and helpful as we discuss the JEPI ETF that can be a great investment option for those seeking to earn regular dividends. With its diversified portfolio of high-quality, high-yield preferred securities, the JEPI ETF can provide investors with a reliable stream of income. However, like any investment, it's important to do your own research and consider your own financial goals and risk tolerance before making a decision. We encourage you to consult with a financial advisor and carefully review the JEPI ETF's prospectus before investing. If you found this video helpful, please give it a thumbs up and consider subscribing to our channel for more informative content on investing and personal finance. And as always, thank you for watching.